What's going on, guys? Another quick breakdown bite here discussing Credit Suisse and their deal to be bought out, bailed out, however you want to describe it, by fellow Swiss banking giant UBS. All right, so basically TLDR, Credit Suisse has been going through a lot of troubles, and this weekend a deal came together for UBS to buy them for $3.2 billion, plus a whole bunch of other things that we'll get into that come from the Swiss government. And I want to discuss today why people are paying attention to this, why it matters outside of just Switzerland. And I think there are a couple reasons. One is that in the wake of the failures of Silicon Valley Bank and Signature, et cetera, in the US, everyone is looking for more dominoes in a globally challenged banking sector. Everyone is trying to understand to what extent the problems of these banks that are seemingly having big problems are theirs and theirs alone, based on risk management, based on the concentration of depositors in a particular sector, which has been more hard hit by changes in the interest rate environment than other sectors, or whether there is a larger systemic issue that might cause more banks to experience problems. So that's one. People are just trying to understand, and anytime in the wake of a Silicon Valley Bank failure that a bank seemed impaired or at risk of failure, people would be paying attention regardless of its similarities to Silicon Valley Bank or not. But there's something that makes Credit Suisse an even more important one to watch, which is its designation as a GSIB. GSIBs are globally systemically important banks, and this is a distinction that has really specific ramifications. GSIBs are banks that are determined to be so significant in either their size or their interconnection to the global financial system that if they were to fail, they would potentially take down that financial system, right? These are the too big to fails, but globally, right? Not just in the US. And GSIBs are subject to a whole different set of requirements and challenges, more stringent stress tests, etc. Credit Suisse is a GSIB, and so people are watching closely, or we're watching closely, to see what would happen with it. Now, Credit Suisse's problems are, although it's a GSIB, although it's a part of larger kind of moment or a larger moment in the banking sector, Credit Suisse has a lot of crap on its own balance sheet, you might say, or its own ethical balance sheet, right? Credit Suisse has been involved in the Archegos scandal, Archegos being Bill Hwang's hedge fund. It has had, it was wrapped up in the Greensill scandal. It has had a criminal conviction for allowing drug dealers to launder money, as you've seen here, entanglement in a corruption case, so much, right? Credit Suisse has not had a good time of it. For many reasons of their own making. And over the last few years, it has tried to restructure itself a couple of different times. Now, to do so, they tapped financing from the Saudi National Bank. They sold about 10% of the company for that funding. This most recent round of challenge was kind of set in motion by a question that was asked to the Saudi National Bank of if they would invest more into Credit Suisse. Now, Credit Suisse had already seen pretty significant outflows. They saw $100 billion of outflows in Q4 of last year, and some of that was kind of picking up steam again. But when the Saudi National Bank said absolutely not, they would not be investing more, that really got investors headed for the exits once again. So last week we were seeing $10 billion a day in outflows. Now, to solve this, or one of the ways that they tried to solve this, was with a credit facility from the Swiss National Bank. Swiss National Bank set up a 50 billion Swiss franc credit facility that was meant to allow Credit Suisse to handle these outflows without having to, turn to other sources. As it turns out, this was actually not a way for the Swiss National Bank to shore up Credit Suisse as an independent concern, but as step one for a change in the way that Credit Suisse would be managed. This was, as has come out, basically just a way to buy the Swiss government time to engineer a deal for Credit Suisse to no longer be independent. The deal that came about, as I mentioned, was with UBS. It involved about $3.25 billion in payments from UBS, not really payments exactly, but shareholders being converted to UBS shareholders at a steep discount to the trading price on Friday when Credit Suisse stopped trading. And in addition to that, the Swiss government is backstopping something like $9 billion of anticipated losses for UBS on behalf of Credit Suisse, and they're providing a $100 billion credit facility for UBS for around Credit Suisse as well. Now, to give a sense of the scale of these numbers, the Swiss GDP is around $800 billion, and the Swiss National Bank's balance sheet is around $884 billion. So offering this backstop of $100 billion, although of course they're not anticipating all of that being needed, represents a significant national investment in keeping these banks solvent, which I think speaks to just how significant the banking system is to Switzerland's economy and to its own sense of self, its reputation. And further evidence of this comes from a Wall Street Journal piece about the deal that suggests that at the last minute, at the 11th hour, the Saudi National Bank actually made a separate offer, an alternative offer that would have injected $5 billion into Credit Suisse. Again, remember the price was $3 billion from UBS. So this is nominally a better offer. In fact, Credit Suisse bondholders would have been protected, which, as we'll see in a minute, was actually pretty significant. But the Swiss ministers said absolutely not a chance. They were not going to really consider this deal. I think this is why some have characterized this as sort of a soft nationalization. That's what I call this in my podcast, which comes out a little bit later. And I think that even if it's not exactly a soft nationalization, it certainly brings up a question of where private ends and public begins. And that's a line that gets blurrier and blurrier the deeper into financial crisis we get. There are some who are asking that same question in the context of U.S. bank protections. When the U.S. government steps in to backstop depositors of a bank, or what does it suggest about, again, where those lines between public and private end? I think those are conversations that we're going to have a lot more of the deeper into this banking and financial crisis we get. Anyways, the deal got done, and as part of it, a big loss for or one big category who is of shareholders, or not shareholders, of investors who are being wiped out, are the $17 billion of AT1 bondholders. AT1 bonds are additional tier 1 bonds. And this was an instrument that was developed after the global financial crisis as a mechanism of getting private money back into European banks to help them restructure and recapitalize without relying solely on government funds. The whole idea of AT1 bonds is that they be sort of an equity alternative that might come with more upside along the way, but also potentially different treatment during bankruptcy. And so the fact that they were completely wiped out has many wondering if that's going to undermine the other $250 billion or so worth of these AT1 bonds that are floating out there. And I think it's important to note that part of the calculus for these bondholders was that they assumed, following the GFC, that if a globally system, that basically the G-SIBs would not be allowed to fail. What we have in Credit Suisse is a sort of failure, a partial failure. It's a failure enough that these bondholders were wiped out, and that fundamentally changes the risk calculus, which maybe it was worth it, maybe it doesn't matter, but it does suggest that investors are going to be a lot less likely to buy this category of bond going forward, which could limit the mechanisms that global governments have to get the private sector to recapitalize banks that are impaired, right? And it's not just me who's suggesting this. Krishna Mamani, who is formerly the head at Invesco, says, I think if there was a playbook for how to turn a semi-banking crisis into something much bigger, this is how it would unfold. When someone asked what specifically he was concerned about, he says, concerned about capital adequacy of European banks and a markdown on AT1s causing all sorts of selling in corporate bond portfolios. I hope I am wrong. Totally wrong. So lots of people are discussing this. I'm far from the only one. And I think that in some ways, we're just going to have to wait and see what the market says. In the meantime, in the US, there are, continue to be questions around First Republic. It's deep in conversations, it sounds like, with Jamie Dimon and JP Morgan. And so this banking crisis just continues on. And as much as we'd like to say, hey, it's done, it's clearly still very top of mind for policymakers. Yet another piece of evidence for that is that the Fed changed its swap lines with global central banks to move from weekly to daily as a way to shore up dollar liquidity around the world. We're still in the thick of it. So anyways, guys, that is the update on Credit Suisse. Hopefully you have a better understanding of what's going on there. We'll be back, I'm sure, with more updates soon. But until then, peace.